Welcome back to our video series. This video is titled, Your Company's Financial Management Dream Team, the Back Office. I'm here to guide you through understanding the essential financial team every company needs. Please take note that BACC is spelled B-A-C-C. It's an acronym for Bookkeeper, Accountant, Controller, and CFO. And in this series, we will explore the roles for each of these critical positions. First, let's address some of the realities of launching and growing a company. Every company has the needs of financial tabulation, reporting, forecasting, and governance. These tasks and the required skills to perform these tasks vary from company to company. In a moment, we will detail each job position individually. For now, I want you to keep in mind that a smaller company with less than 25 people may have the tasks of a bookkeeper, an accountant, and maybe even the controller all in one person. A smaller company of under 100 probably does not even have a staff CFO. The owner or owners are likely doing the best they can to fulfill the responsibilities of the CFO, but this critical role and its accompanying tasks often go undone. The other end of the spectrum, at least from a staffing perspective, is a company with 300 to 500 employees or more. They probably have at least one bookkeeper, maybe more, an accountant, a controller, and a CFO, all on staff. The individual roles would be clearly defined, creating an entire team of 4 to 7 financial professionals to support every financial need the company has. So what exactly is each job position intended to provide the company? Let's start with the bookkeeper and the accountant positions. Most people do not understand the difference between these two job positions. Keep in mind, all bookkeeping is accounting, but not all accounting is bookkeeping. Think of it this way. All roses are flowers, but not all flowers are roses. A bookkeeper tabulates the historical transactions in a company, transactions which have source documentation. Let's pick apart that definition because there are two critical aspects of how the role is defined. Critical aspect 1 tabulates the historical transactions. The bookkeeper is documenting what has happened with the money flowing into the company and the money flowing out. All are historical events. They are entering data into some sort of bookkeeping system, detailing what happened the previous day, week, month, or year. The bookkeeper could be using software such as QuickBooks or even just Microsoft Excel to do this. Let's move on to critical aspect 2, has source documentation. The bookkeeper will record the historical transactions of the company by referring to some sort of document regarding the financial transaction. If a sale was made to a customer, there would be a receipt from the purchase. Both the customer and the company would have a record for the transaction. If the company buys a product or service, the company would have been provided with a receipt. Even if a receipt was not provided, the company bank statement would show the funds being deducted from their bank account. No matter what financial event occurred, the bookkeeper would have some sort of paper trail documenting the transaction. An accountant, on the other hand, may not have a document from a transaction to refer to. Think about the recording of depreciation for a moment. Depreciation is the allocation of an expense over time. The determination of the specific expense to be recorded is based upon accounting formulas and government rules. The accountant is knowledgeable of these rules and can properly calculate what the amount should be. No person or organization sends the accountant a bill for depreciation. The accountant must be knowledgeable enough to attend to these duties. The accountant also knows how to take the historical data from the company and produce financial statements. There is an accounting process known as closing the books. The accountant would know how to close the books and then produce the financial reports after having closed the books. Now let's turn to the role of the controller. The controller is your internal financial watchdog. The controller ensures the financial reports prepared by the accountant are following all the accounting rules, the government rules, and any industry-specific rules. Tax compliance and internal audits are the responsibility of the controller too. The controller will also ensure proper practices are followed to prevent fraud. Providing detailed financial data and internal reports for the CFO is another area of responsibility for the controller. Now let's focus on the last member of your financial dream team, the Chief Financial Officer, commonly known as the CFO. The CFO role is the forward-looking member of your financial team. The bookkeeper, accountant, and controller are attending to what has happened with the company, while the CFO focuses on what will happen with the company. The CFO collaborates regularly with the CEO and board of directors. The CFO studies all the historical information of the company and helps to guide the company forward. The guidance of the CFO focuses on the financial performance of the company. Typically, each year, a company will have an in-depth meeting to determine the company focus, goals, and needs for the next year. The CFO creates the business plan for the upcoming year, detailing how the company can attain these goals set by the CEO and board of directors. On an ongoing basis, typically monthly, the CFO will provide forecasted to actual reports. These in-depth reports detail what was projected in the business plan and what happened in real life. More specifically, what happened with the revenue and expenses. The report begins with a column of numbers labeled forecast. Next, a column of numbers labeled actual pulls numbers from the financial statements and is placed next to the forecasted numbers. Two additional columns reveal the difference in the forecasted to actual amounts as a dollar amount and as a percent. Another column labeled favorable or unfavorable reveals if the amount shown in the actual column was beneficial or detrimental to the company. Keep in mind that in accounting, more or less does not equal good or bad. It only means other than projected. Along with the numbers will be a written explanation of each revenue line item and each expense item. This level of detail requires an intimate knowledge of the financial workings of the company and a thorough understanding of accounting. Having the CFO support the CEO and board of directors in this way allows the CEO and board of directors to focus on the big picture of the company and achieve their vision. Quick side note, I'm using the terminology of CEO and board of directors. In this circumstance, we're referring to whoever owns the company or is at the top of the decision-making pyramid. The title could be founder, president, managing member, managing partner, or some other title. Just keep in mind that the CFO is providing information directly to whomever is the highest level of decision maker in the company. One last way to view the CFO position is that someone must understand the vision of the company and know how to get into the weeds of the financial details. We all know that if the numbers don't work, the company may crash, and nobody wants that. We all want the company to thrive. A good CFO is the key to making the numbers work for the company and therefore the financial success of the company. The next video in this series will explain when to hire two members of your back office dream team, the bookkeeper and the accountant. See you again soon.